We are going to have fun today because we are going to talk about taxes and do a science experiment. We're going to talk about capital gains versus ordinary income and whether capital gains can push you into a higher bracket. Let's define ordinary income. Ordinary income are any wages, commissions, rents, royalties, interest from bonds, those sorts of income. Short-term capital gains occur anytime that you sell an investment that is held less than a year for a profit. So if I bought something today and I sold it for tomorrow and it went up in value, that would be a short-term capital gain. And those are taxed at ordinary income tax rates. But long-term capital gains have their own separate taxation and they're more favorable typically. And long-term is anything that's held longer than a year. So if I were to buy something today, the investment went up in value and I sold it more than a year from now, that would be taxed as a long-term capital gain. For the rest of this video, you're going to hear me refer to long-term capital gains as just capital gains. I do that just to make it a little bit easier and for the video to keep going, but keep in mind that long-term capital gains and short-term capital gains are different. The types of strategies that I'm talking about refer to long-term capital gains because again, short-term capital gains are going to be taxed at ordinary income rates. I don't want to get into the numbers. I want to go do a science experiment. If you remember as a child, you'd mix things together and see which things would rise to the top and which ones would stay below, the different mixtures of liquids. We're gonna do that today, but in tax form. So come on, let's go to the kitchen. So here you'll notice that we have an empty cup and I'm gonna fill it with water now. Water is gonna represent ordinary income. So let's fill it up. Okay, we have the water in there. Now, I'm gonna add oil to it. Now, if you remember what happens as a child when you put oil with water, well, let's see what happens. So I'm gonna pour the oil in, and here we go. The oil rises to the top, and the oil is representative of capital gains. So we have the water or the ordinary income on the bottom, and capital gains or the oil on top. Whenever we mix these two together, the water is always gonna go to the bottom, and the oil is always gonna be on top. Now, let's reverse this. Let's say instead that we have capital gains first. So I'm gonna pour oil into the cup first. And now I'm gonna add water. What happens? Well, the water or the ordinary income goes to the bottom, while the capital gains, or the oil in this case, go to the top. And this is an easy way to remember whether capital gains can push you into a higher ordinary income tax bracket. They can't, because ordinary income is always going to go to the bottom. The water is always going to go to the bottom regardless of what's in the cup first. And so that's an easy way to remember which one affects the other. So in this case, if you have more ordinary income, you can affect your capital gains bracket, but your capital gains will never affect your ordinary income tax bracket. Now, I've got a chart here to help make sense a little bit more of the oil and water analysis. So let's look up here, and we can see here that if you have ordinary income, that's gonna push your capital gains up, whereas if you have capital gains, it's not gonna do anything to your ordinary income. Now, let's look at a real world example here and bring this oil and water to life. So let's say that you have $50,000 of ordinary income or water and $80,000 of long-term capital gains, that's the oil. And we can see up here in this chart how that breaks down. In total, you have a gross income of $130,000, and assuming this is a married couple filing jointly, once we subtract out the standard deduction of $25,900, that's gonna bring their taxable income to $104,100. And then from there, we can see how the oil and the water mix together. So the water or the ordinary income floats to the bottom, and we've got about $20,550 that are gonna be taxed at the 10% ordinary income tax bracket, and then you can see the $3,550 being taxed at the 12% ordinary income tax bracket. And that's where your ordinary income tax bracket stops, because then keep in mind that the long-term capital gains, they're gonna be taxed at that separate rate. Again, we had that separation of the oil and water earlier. And in this case, we have two tax brackets that are going on here within the long-term capital gains tax bracket. We have a 0%, and we also have a 15% long-term capital gains tax bracket. And so what you end up with here is $59,250 that are taxed at 0%. So you're paying zero tax on $59,250, which is a phenomenal deal. And then on top of that, you have additional capital gains that are being taxed at the 15% tax bracket. In this case, it's $20,750 that are taxed at the 15% tax bracket. So this chart is a great visual of what happens when you have a mixture of capital gains and ordinary income and how they interplay. Although our tax code is complicated, I hope this oil and water example helps you remember that capital gains cannot push you in a higher income tax bracket, but ordinary income can affect your capital gains bracket, as we saw earlier. Remember, water or the ordinary income is always going to fall to the bottom. Oil or capital gains are always going to rise to the top. If you enjoyed this content and want more of it on a regular basis, please click the description down below and subscribe to my newsletter. Thanks for watching.